Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing today?
I am good, Joe. I am sitting here looking at some gray skies for like the first time that aren't smoke. That is a little bit of rain here in the Seattle area today, which, I'm not minding that, I'm not minding the refresh that's happening this morning here.
Nice.
Yeah, on a Tuesday. What day? No, it's Wednesday. What day is it? I lost track. Today's Wednesday.
It is.
What are you up to today?
Just still hanging out in Durango, Colorado. Hopefully going to do some mountain biking this afternoon, although it's kind of windy here, so we'll see if there's a storm rolling or not. You never know around here.
Yeah, right. Well, your best friend, Eric B., took quite a tumble on his mountain bike. How are you protecting yourself or not doing the same? And are you wearing any type of camera so we can watch this fun stuff while you're
I am wearing a camera, and I was actually just talking before the podcast with our guest Ryan about mountain biking, and I in Sedona, California, was riding some of these trails that were massive drops, like crazy stuff. Like I've never done anything like it, and I had a camera on the bike because I ride with a GoPro most times. And the cool thing about the GoPro, these new ones, is you can say GoPro start recording, so you don't even have to hit the button. You just say it and it starts recording. And so like you see this cool drop coming up and you say GoPro start recording, and I'm riding down this amazing craziness drops that I wouldn't recommend most people do, and then I go back and review the camera, and GoPro smooths things out so much that it looks like I was just having a leisurely ride down the trail. So yes,
I'm surprised you can
it.
get your service out there because you lose your connections and the GoPro still works.
Oh, the GoPro is just a camera. It's not connected. Okay. I mean, it's connected to the phone, but it is kind of hard, though, because you get these really big video files, and you have to go and load them onto your phone and then load them up to the internet. And that can be challenging. I've got like hundreds of videos from the Grand Canyon trip we went on that haven't been shared yet because they're just so big, and I haven't had fast enough internet to get them up to the web.
Can't wait to see those. So if you guys have been listening to our show for a while, my partner Joe Bauer here is living the lifestyle of extreme fun in the outdoors. And you're off in Durango, Colorado right now, which is my transition into our friend Ryan Gibson with Spartan Investment Group. Their offices are in Golden, Colorado. So we got a little, I don't know, that's the best I can do for a transition today, guys. That's all I got, right? Joe's living how about this one? If you guys want to live a lifestyle like Joe is living, where you can be on the road 24/7, living in your kick-ass van, enjoying the outdoors and all the seasons, you're going to need some passive income. And one way to do that is investing through a syndication. There you go. There's a transition.
Hey.
And yay, figured it out. And today we have my good friend and partner, because I invest with them as well, Ryan Gibson of Spartan Investment Group with us. What's up, Ryan?
What's going on, Julie? What's going on, Joe? Thanks for having me. Yeah.
Well, Ryan, you had some exciting adventures. Didn't you do enchantments this summer?
I did the enchantments, and that was the most amazing hike I've ever been on in my entire life. And I hike all the time. So
how long is that? How do you have to, how far in is that, and how many days in, and you got to backpack in?
We raised money to combat human trafficking. There's a foundation called the Freedom Foundation, and I think they're a nonprofit based actually in Bellevue. And we hiked from one point, so it was point to point hike, and it was 24 miles in one day. So we actually got to the trailhead at about 3:00 in the morning. It was amazing. It was, clear sky, stars were out. We hiked with headlamps until about 6 a.m. and then the sun came up. And we went all the way through Kolchak and down the backside through Snow Lake and got picked up on the other end. So it took us, we started walking about 3:30 in the morning, and we were all said and done about 6:30 p.m. at night. So not too
Wow.
bad. Yeah.
Where's the start point for that? Like, where do you drive to even get started? I'm sure there's more than one access.
Yeah, so I can't remember I think we went in, so we were stationed kind of in Leavenworth, and then we started, it's the hike that takes you to Kolchak,
Gotcha.
Kolchak Lake. So whatever, I can't remember the name of the trailhead, but well worth it. It was, I had really no complaints about the trip. The hike itself, I mean, it was long. It wasn't very hard. We did it, in late July, so the weather was stunning, and we went swimming in the glacier lakes, and I had a great time. It was a lot of fun. And
that sounds good.
Yeah,
we could talk about this forever, guys. Our listeners today, we could go on and on. We all love the outdoors.
Yeah.
All Joe and Ryan and myself here, but I think it's a good time to point out the reason why that you're able to do that is again tied back to real estate investing, passive income, although maybe not so passive for you, Ryan, since you're running Spartan Investment Group, although you have an awesome team, but that allows you to go do something like that. So let's jump into it today, because we could go on forever, the three of us, as we had the longest pre-show talk that we've had in a long time, because we all love talking about all these things. But I want to let everybody get back to work and get back to their investing here today. So I'm going to jump into it.
Awesome.
So today, everybody, we are going to be discussing investing in real estate syndications as opposed to in addition to other investment vehicles. And for those of you that aren't familiar with what syndications are, they're partnerships that allow investors to pool their capital together and invest in larger properties or different asset classes than they can purchase and manage individually. And, Ryan, we were saying, that there's maybe some misunderstanding or just non-education about how you can get started, even if you're not wealthy and experienced in this sort of stuff yourself. Go ahead and say something about that.
When I first heard about syndications, I heard it from somebody that said, you don't have to have millions of dollars, decades of experience to buy a 250 unit apartment building or 1,000 unit self-storage. You can invest with an experienced operator, and for as little as $25,000 to $50,000, depending on the operator's minimums, and own a piece of real estate like that and benefit from its profit. So you can actually directly own a commercial piece of real estate on a specific address, specific project, without having all that stuff. Which I thought
one thing I'll add is let's say you're a real estate, you've got some rentals, or you've bought some real estate here or there as investment properties, and you are looking to move up. You want to buy something bigger for yourself, even if you want to do it on your own. A really great way to dip your toe into that water without taking on all that risk, without having all the experience as you grow as an investor or yourself, is to invest in a syndication and see how it goes, see how they communicate, see what comes up, see how they do things. That whole thing will only educate you to teach you further how to do that your own. You're on your own, buy those properties outside of syndication or start your own syndication. It's kind of like riding along with the more experienced investor than you are to learn the process as well, or in addition to just jumping in to these bigger asset classes without being the expert.
Julie, that's a really good point. And the first time that I ever did a syndication, I invested in somebody else's deal, and it was a self-storage development, because that's what we focus on now. And I got a front row seat to the action. I didn't have to go up on the stage and perform, but I got to sit right in the front row and watch the show. And having my money in the deal, it just makes all the difference that I was invested in that person's deal. And I was just that much more engaged in the process because I had my money in the project. So you're absolutely right. If you're thinking about doing a bigger deal or something like that, the idea is that you would find a good operator and then invest with them and see how they do things. That's critical.
What's interesting is I'm an investor myself in your deals. And we're going to talk about that a little bit later. But when I see who else is invested in your deals and I recognize some of those names, these are some of the biggest names out there doing syndications, their own deals that are investing with you. So you're really, getting an opportunity. It's interesting that people who can do it on their own, have their own syndications, are investing in other, syndications, right? For their own diversification of their own portfolio, right? So even big players, it's kind of like real estate, the whole real estate guru and education world, even in our small bubble here in the Pacific Northwest, all the educators and, people that are sharing and trying to lift everybody up, like myself and Tarl and Grace, Jennifer Beatles and Jan's group, we all talk and help each other. And I think, it's interesting. I've noticed in the syndication, being an investor with you myself, how almost I see credibility just by who's investing with you when I'm investing with you, right? And so I just want to say that that's something I've never discussed with you, but that I've noticed myself as I'm vetting and looking at who to invest my own money with. So let's just keep going down the pipe here. So today is meant to introduce and enhance your knowledge about real estate syndications and what they're all about and why you might consider investing in them, and introducing to who I think are top-notch and high-integrity syndicators that I have vetted myself. So one of the primary benefits of investing in a syndication is that it's a completely passive investment. When you invest in a syndication, you're a limited partner, and but yet you can receive the benefits of direct investment without the headaches of dealing with the day-to-day management of the property, as some people call tenants and toilets. There's a lot of people out there. I can't tell you because I'm a investor, but I'm also a traditional real estate broker, both for residential single family stuff as well as commercial brokerage. I've been around a long time, over 20 plus, I even might think it's 25 years I've been in real estate. So, investing in syndications gives you the opportunity to diversify your portfolio into an asset class, that's not directly tied, for example, to the stock market volatility. And right now, especially, I think, is a time of turmoil, pandemics, crazy politics, and it is the perfect time to educate yourself and learn more about how to protect and grow your wealth with all these crazy things going on in our world right now. So not only, and the reason why I've asked Ryan to be on here today is, not only are my friends at Spartan Investment Group highly regarded syndicators, but they are constant and continuous educators on all topics related to real estate investing, tax planning, asset protection, and that just, again, they're an open book. They'll teach you, everything you need to know about syndication, how to invest, how to do it yourself if you want to. And so you can access their full library of education on their website at spartan-investors.com/learn. And Joe is going to drop a link to that into the show notes. So Ryan, we really appreciate, I know how busy you are. You've got 2 young kids yourself, and I can't wait till let's get to know you a little bit better. Tell us a little bit about your background and how you got started.
Yeah, sure. So I was from Detroit originally, but lived in DC for a while. And formerly, I actually was an airline pilot for Alaska Airlines. And so I flew the 737s, I've flown the 757, 767, so kind of a background as a pilot. But the real estate stuff happened. I started pilot housing for pilots that had to commute into their jobs. And eventually I've always been just a little bit entrepreneurial. And when we moved to Washington, D.C., I flipped my first house, which was the house that we lived in. We kind of house hacked our way into a rental property and really enjoyed it. And then one day, a guy was walking down the street named Scott Lewis, my business partner, co-founder of Spartan Investment Group with me. And we ended up becoming good friends and neighbors. We flipped 4 houses on the block that we lived on. And we started to get into condo development where we would take townhouses and convert them into a condo building and then sell off the individual units. And, after a few years of doing that, we decided, what asset class performed the best during the last 2 recessions. And that was the standout was self-storage. And we thought, we're really hands-on guys. We want to do all aspects of the business and to scale it. We wanted to do all of our own property management, all of our own asset management, all of our own construction, and, not do it as individuals, but have our company hold control of the value and the quality. So storage we really like too, because easy to evict, easy to maintain, and easy to operate. So now we went into the storage space, and we've got about 5,700 units now, maybe a little bit more. And, we just love the asset class. We've got about 30 full-time employees now at Spartan. We just opened up a Bellevue office, Julie, so that's kind of cool. Yeah. We brought on, so there's 3 people working out of our Bellevue office now, a 4th pretty soon. And then we have about 15 or so of our staff in Golden, Colorado, as you mentioned, at our headquarters. And then the rest of our employees are out in the field, working at the self-storage facilities, and we also have a couple of RV parks that we invest in as well. So it's really grown a lot, really scaled a lot. Scott had a background in the Army. He was he's an Army vet, and he served in Iraqi freedom. And he comes from the mindset of, the military strategic decision-making process. He's got a background as a PMP, project management professional. And then my background in airline operations, checklists and procedures-driven approach. We've really started something that is very well thought out, very conservative, and gives investors a place to put their money and kind of reasonably expect a nice return. So it's been a great.
And I've been watching your, I'll say, measured and controlled growth over these last several years, and it is very impressive what you guys have grown your organization into. In fact, I want to give you a shout out here because I don't think I've actually talked to you since the news came out. But tell us what happened this year. Spartan was named. I'll let you finish it.
Yeah, so we made the Inc. 500 fastest growing private companies. We were ranked 308th in the nation for fastest growing companies, and we were ranked 8th fastest private real estate company. Fastest growing. So we were really excited about that. We had 1,450% growth from 2016 to 2019. So that's measured by your revenue. And super excited. What's even more exciting, I don't want to get ahead of myself, but I will a little bit on your podcast. But we've measured our growth from 2017 to 2020, and it's over 4,000%. And it's, that will put us hopefully back on the Inc. list, depending on how everybody else does.
And that's based on a revenue measurement?
Yes. Yeah, revenue.
Which is shared and participated in by your investors.
Absolutely. Yep. Yeah, and what's great is, with the storage focus, next year, ISS, Inside Self Storage, ranks the top 100 operators. So we'll be hopefully on that list. Based on this year's list, we would have made it, but we didn't do the submission. But next year, we'll be hopefully in the top 100 operators with just shy of 1 million square feet of self-storage under ownership. So things are really coming together. And I credit that back to Scott, who, really wanted to plan. And, we spent a lot of years really not doing a whole lot, to be honest. A lot of planning, a lot of where we want to go, and we share our strategic plan, which we redo every 3 years on our website. You don't have to fill out your email or anything. You can just go to our website. There's a strategic plan that you can download. And that maps out our strategic plan, which goes through the end of 2022. And our goal is to have 250 million of assets under management by the end of 2022. And right now we're about 130, 140. So we're well on our way to hitting our targets. So the growth has happened, exponential, nice hockey stick growth. And it's been manageable. I've been able to have a nice life and go hiking, and it's been a lot of hard hours, but
we have a few babies along the way.
A couple babies.
Sell your house, buy another one. Yeah.
Yeah, Julie sold my house, and we bought another house, which is awesome. And so it was, it's kind of a nice, it's nice to have good people. And I know I'm going to go on a little bit of a rant here, but we have so many good people working for us, and I just can't tell you how happy I am to be working with good people. It's the only thing that matters. And, we've really taken our time to hire the right people and invest in our values, which is, growth, respect, integrity, tenacity, and transparency, and make sure that people have good value alignment with what we have as our mission, vision, values for the organization. And I think that's really just attributed to us doing, getting the growth and having success while we grow, which is important. So.
And I will also back that up by saying this is exactly why you are on the Nuts and Bolts of Real Estate Investing podcast, because that is my number one mission, is to, provide vetted, educational, inspirational, detail-oriented, deep dive information. It's really selfish because I want to learn about these things myself, and I've been talking about these things for years and years. People come to me and ask me questions and for referrals on this and that, and kind of sitting atop just a deep Rolodex of vetted, people that I deal with here. And we are so happy to be involved with you all these few years, Ryan, or these last several years, and watch your growth. So thank you again for your time, because I know how busy you are. So let's keep going here. So let's start off just a little bit of a little educational question, because I think there's a lot of people that, you talk to your financial advisor, you sell a big piece of property, or you cash out of the stock market or something like that, and you're looking to reposition your portfolio or your funds, which is a big topic of discussion today, right now, with everything going on in politics and the change of, who might be in the White House and tax proposals and things like that. Repositioning your portfolio. A lot of financial advisors probably talk to their clients about REITs and stuff like that. So what's the difference, so people understand, between a REIT and a syndication?
Yeah, big difference. Almost no similarities other than the underlying assets tend to be real estate. So just to give you a quick history on REITs. REITs were started by a piece of legislation from President Eisenhower back in the 1960s. And the idea was that they wanted to make REITs, or commercial real estate investing, accessible to all Americans. So you can invest, I don't know what the smallest REIT price would be, but you could invest, hundreds of dollars and own, a part of a REIT that effectively owns commercial real estate. That goal has been achieved. Over 145 million Americans have REITs in their, in their portfolio of stocks, bonds, mutual funds, whatever it might be. There is a huge difference, though, between REITs and a syndication. REITs are speculative, and REITs do not come with tax benefits. So those are the two things that really distinguish between a syndication and a REIT, and I'll dive in a little bit deeper. So when coronavirus came out, there was speculative shockwaves that hit the market on what was going to happen to multifamily, self-storage, office retail, and all the other asset classes. And self-storage REITs took a 15% hit just for the reason of speculation. Now let's compare that to what happened with a syndication. So Julie, I'm going to pick on you a little bit. You're invested in one of our self-storage syndications, and you can pretty much tell me what happened when coronavirus hit. And the answer is nothing happened. You continued receiving a distribution every month, and our occupancy not only held steady, but it actually increased, and delinquencies went down a little bit. So when you invest in a REIT, you are subject to speculative what can happen, and what's going to happen to self-storage in general. The other thing about REITs is you're not investing necessarily in a specific project. So when you invest in a syndication, if it's a single purpose entity that you're investing in, you're investing in that self-storage facility in Tacoma, Washington on 123 Main Street. You're investing in a very specific project, specific deal, and a hard asset. A REIT, you may be buying a portion of Public Storage or Extra Space or CubeSmart. Those are publicly traded REITs, or Life Storage. So you're buying into their whole business model. You're not necessarily buying into a specific property. So while there is some commercial real estate assets in there, you don't really know what you're buying.
You don't get a choice to what you're investing in.
And you don't get a choice. Yeah, and I shouldn't say you don't know what you're buying, because you can look at the prospectus and read the 150 pages of the prospectus and figure out exactly what assets they own. But it's confusing. You don't know what you're buying. You can't decide what syndication to do. You're just buying a generic thing. That's probably the biggest difference. The second difference is the tax implications. So, Julie, as you know, when we buy an asset, we get depreciation. And that depreciation shields those distributions that you've been earning from taxable income. So, for example, when we bought Mini West back in the self-storage facility that you're in back in 2019, there's a depreciable benefits that flow to you on your tax return. So you got I don't know what it is off the top of my head, but you got thousands and thousands of dollars in losses based on your investment. And so that shielded any taxable distributions that came out last year, and there's enough tax shield to cover all of this year and probably all of next year. So the reality is you're not going to be paying taxes on those distributions. In a REIT, you're not getting any taxable benefits. It's kind of like buying a stock. If a stock has gain and you sell it, at the end you're going to pay taxes on any distributions or anything like that comes from those, or dividends that come from that REIT. So huge difference, in just the generalization of a REIT, and then also the stock benefits as well.
Great explanation right there. I'm going to ask you about a Delaware statutory trust, the DSTs, later maybe, but we're going to keep rolling here. Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show. So how about sharing a case study with us of one of your stabilized assets so people can understand a little bit more about one of your, multitude of deals that's an example of what you do?
Yeah, sure. So, we have, just kind of staying on topic, kind of kind of our bread and butter deal, so to speak, is an existing self-storage facility that either has one or two things: operational improvements, and I'll explain that more, or it has expansion potential, or it has both. So an example storage facility we bought right in the middle of COVID is north of Denver, Colorado, Devonshire Storage. You can look it up. And that facility we bought, the owner was in his mid 80s. We sent that facility a bunch of letters. We got the seller to sell us to us off market, and we went in there. The owner, lived on the other side of Colorado, Denver. Just completely let the place fall apart. Was doing an okay job running it, but for the most part, he was a tired owner. He was your typical. It was paid off. He was making a bunch of money. Who cares, right? So we took it over, and he just wasn't collecting the rent. There was a 28% delinquency rate on the property when we took it over. We're down to about a 6% delinquency rate now. We bought it back in April. So, our team takes over and we lay all the foundations to making it a successful business. We put in a call center. We put in a new manager. We train our manager on sales. We train them on our new revenue management system. We have online 24/7 sales online. We make it easy for people to pay, easy for people to book. We make it super convenient to pay and to rent units. We also add a bunch of ancillary revenues such as tenant insurance, and we repave the drive aisles. We put in new cameras. We better light the property. We repaint the facility. We rebrand the facility in totality. And that property, there wasn't any units to add. We've pretty much completed all of our capital improvements. The facility is about 90% full. Despite COVID, we raised rents, we reduced delinquencies, we auctioned off people that weren't paying. We can auction off their belongings, and we've stabilized the property. That property is making monthly distributions to our investors, and for the most part has been completely turned around and improved. Something like that, it doesn't take us very long to do that because we have a professional team at Spartan. We have Jackie's team. She's our director of operations, and she has Danica, who's our inside corporate property manager, and then we have Cherie, who's our property admin. And when we take over a property, they deal with the operations, and then we have a capital projects team. We have a licensed contractor on staff, Garrett Van Manen and Scott Lewis, who do our capital projects. Scott isn't licensed, but Garrett's licensed. So we come in and we will handle all the things that I just mentioned: the driving, the paint, the drive outs, the painting, the cameras. We do the whole thing, soup to nuts. And then our investors, get the advantage of having a steady distribution on the property. So it's that's one example of a stabilized property.
Did you say, are you guys putting debt on your purchase, and then do you refinance and hold long term? What does that type of stuff look like?
Yeah, great question. So once we complete our business plan, which we've pretty much done here, we do want to get the property up a little bit more in occupancy and get the rents up. But for the most part, our business plan is pretty much completed for that facility. So investors get paid a couple of ways. Operating distributions are cash flow. So, money comes in, we pay our investors some kind of preferred return, usually 6 to 8%, depending on the project. And then when the property, then they get distributions from liquidity events. Liquidity events are two different things. Could be one of two different things. One, when the property sells, if there's profit, the investor gets paid a portion of the sale, gets upside returns from the sale. Or if the property's refinanced and there's a cash out event, the investor will get money back as well. Sometimes it could be as much as their full amount. Sometimes it could be a portion. But when we eventually do sell or refinance our properties. So that's
which is not a taxable event.
Correct.
Just to point out, yes.
The sale would be, but the refinance may not be, depending on how you use those funds. So absolutely correct.
Right. Wow. All good stuff. I could talk to you forever and ever and ever. Okay. Well, let's keep going here. And so have you guys sold anything yet?
We have 9 completed projects, of which I think 7 were syndications. So we've had 7 projects that, we bought the asset, we repositioned it, and sold it. On the storage side of things, we've had one property where we bought the property, we did the operational improvements that I just described, we got the land and title to build additional units, and we actually rolled it into a new fund and sold the asset and cashed out the investors that were in that deal. So yes, we've done, I think we're up to 10 completed cycles on projects.
And me personally as an investor, unless I can 1031 out of something, I don't really want something to sell unless I'm going to, step up to another investment, and take those funds and trade up. Otherwise, I'll remind you all that for those of you that are thinking like, oh, I want to make, some double digits return, with all the time with your money, that means that your money has to be constantly invested, right? The moment you think you're going to make some return of, I don't know, I know, Ryan, what would be a high number, you have to remember that if you make any changes or you sell an investment and you don't immediately replace your investment, that your returns actually are going down while your money sits idle, right?
That's
Putting
right.
into perspective what the returns are for syndications.
Absolutely. And the quickest way to say that is, just inflation. Cash sitting is subject to, the declining value of the money that sits and that isn't placed. Absolutely.
So that's a whole nother topic for a whole nother day. So Ryan, how often and how do you guys communicate with your investors? I know, obviously, and I'm very busy and I feel fully informed. So share with us about that a little bit.
Yeah, so we communicate 4 different ways. One, we do a communication on the 15th of every month. So you get an email. There's no action to take. Like you said, Julie, you're busy, you're out having a good time with the kids. It's just there for you to read if you want to know what's going on. And recently what we did was we actually share what's going on for all of our investments in that one email, because we have people that have invested in almost all 13 active projects that we have.
I love that because I can see all the other project stuff. It just makes me feel even better about things that I can see that.
Well, that's great to hear, because we had that that feedback from our investors, and we thought, yeah, let's just tell everybody what's going on in our entire portfolio, so that way you can say, I saw that deal go by and I didn't do it, and
exactly.
Yeah, I'm curious to see how it's doing, and so or somebody might be in one deal and they're just like, I wonder how all their other deals do. So yeah, we love transparency. We love just sharing. We're an open book, so we just love just saying, hey, here's how all of our properties are doing. And we do a quick occupancy dashboard. So we'll share our occupancy across all of our portfolio. We share our delinquencies. We give you a quick narrative on what's going on. And usually we give you a video for each asset. Not every asset every month gets it, but if we're out there filming with the drone or filming with the camera, we will share that information as well. The other thing that we do is we share the financials every quarter. And, personally, this came from feedback on investors, and then me being a passive investor. If somebody sends me a P&L and a balance sheet, that's great, but I don't know how it compares to the business plan. I don't know how it compares to how you pro forma the deal to do. So what we do is we send out for each asset a property report, and it gives you the revenue, the expenses, the NOI, and the distribution amount, pro forma versus actual. So you can quickly understand in about 10 seconds if we're tracking the business plan or if we are not. And then we give a little bit of a description of what's going on, why revenue is higher than we expected, why expenses are lower than we expected, whatever it might be happening. We give some year-over-year statistics. We're a very data-driven company, and we have about 3 people that work full-time in data, and are measuring these things and tracking our KPIs and stuff like that. So it's great. So that's the second way. The third way we communicate is every quarter we invite our entire all of our investors that are active in our projects to a company-wide conference call, and we go through each market, talk about what's going on in the market from a high level, and we go through each asset and talk about how each asset has performed. And then we open it up for Q&A, and we unmute everybody. So if you got a bad question, you got a good question, a great question, if you want to, you got a bone to pick about what's going on at your property, everybody hears it. It's complete transparency. And those calls are always recorded and sent out to all of our investors within 12 hours of the conclusion of the meeting. And then the fourth way that we communicate, and we're just about to roll this out, is we have an online investor dashboard. So you can log in. The dashboard's already up, but you log into our dashboard. You can see your investments. You can see distributions, and you can do all that. But the last thing we're going to do is we're going to have investor statements. So if you need to pull a statement for your investment, you'll have that available right there on our online dashboard. So those are the 4 ways we communicate.
So those of you who are currently invested in syndications, here's your measuring stick of what you should be expecting from your syndicator, from your operator. And, this is, again, why I've got to introduce you to Ryan in Spartan Investment Group today. So, Ryan, one of the questions that I've been talking to you about for, the last while or whatever is, a need for, and which is a very hot topic today, the whole topic of 1031 exchanges, with everything going around and with, discussion of if that's up on any type of tax proposal chopping block in the future, may or may not be. We'll just have to all be paying attention and continuing to talk to each other and navigate with that kind of stuff with each other. But I've always asked you, like, hey, I potentially could have a need in the future for a big 1031 need. And go ahead and tell everybody what we've been talking about earlier today.
You could 1031 exchange money into our syndications. That's really the bottom line. If you sell a rental property or a bunch of rental properties or a big apartment building, or you come out of some kind of real estate transaction, if it's real estate to real estate, they consider it like kind, and you can invest in our syndication. That's really the bottom line. Now, it's a little bit more involved in the paperwork, and that's okay. We have an attorney, basically that's our general counsel, kind of on staff, not our direct employee, but we have a title attorney that on our team that works with us. Obviously, with all the things that we have going on, we pretty much have full-time attorneys on the title side and on the general counsel side, and syndication side, I should say. And we can do that. So
I just want to say how great news that is, because I can't tell you for myself, and as well as many of my clients in my brokerage business who are, maybe they're getting older and they've had rental portfolios, whether they're single family homes or they are multifamily properties or whatever, commercial real estate, and they are ready to be done because they've self-managed them, for example. And they, their financial advisors have told them maybe about DSTs or something like that. I would 1,000 times rather invest with you guys than throw my money into a DST. As you can all hear from how detailed and their due diligence and their integrity here with Spartan Investment Group, is. Anything you want to add to that on the DSTs?
I do. The DSTs are stable funds. So, typically, the value that we can create and to get to the returns that we could, potentially deliver, I got to use careful words there because nothing is guaranteed, are going to be generally higher projections because a DST cannot be a value add deal. So if you're doing DSTs, those are stabilized portfolios of real estate. So there's a difference. It's a lower return. There can't be any development component to the deal. For example, Julie, neither of the deals that you're in would have allowed a DST. So the Mini West storage that would have not allowed a DST because we had a construction component, even though the property, when we bought the 11 buildings that existed there today, that cash flowed from day one, that part of it was stable. But the fact that we were going to go and add additional units to that property would have disqualified it from being a DST. And that's really where a lot of the value is created in that investment, which gets us to the returns. But DST.
But this is also, we're talking about diversification of
Sure.
your assets here. And so for people who've all, just think that DSTs are, I don't really hear a lot of financial advisors talk about syndicators. I hear them more talk about DSTs, and maybe it's just because they're not necessarily educated on that fully themselves, or don't know any good operators to discuss, right?
Well, there's a lot of misinformation out there. So I just wanted to clarify for, getting a little bit technical, and obviously, check with your attorney and, seek outside counsel. I'm not your attorney. This is just friendly discussion as a disclaimer. But, you can't 1031 exchange into the LLC, that's the syndication. But you can 1031 exchange into a tenant in common where you go on the title. So we have a tenant in common agreement, and we have the ability to do that. So if you called up your, Bill Exeter, or you called up, your favorite CPA, or talked to your financial advisor, and you said, hey, I want a 1031 into Ryan Syndication or Spartan Investment Group Syndication. If that's all you say, they're going to look at it and say, you can't do that because it's an LLC. You can't 1031 into the LLC with, different partnership structure. That is correct, technically correct. So there's a lot of technical things that you have to know, to do, and specifically, you actually go on the title, and so that's why it's not hard. It's just very technical, and we have a team to do and walk you through that. So that's basically what I wanted to clarify about it as well.
And for those of you that are listening and enjoying this stellar education here today about syndication, and you would like more information, maybe you're in a syndication, or maybe you're thinking about investing in one, we're running out of time here today. So what I'll say is contact me, and Ryan and I will get together after the podcast here and maybe create a list that I can give you, which would be the top 5 or 10, however many questions Ryan and I decide, questions that you can use to vet, a syndicator or something like that, right? Because we're showing you the gold standard here today. Okay.
Really, one more plug. We have a investment syndication simplified meetup now, and we meet up every other Thursday. When COVID is not a thing anymore, hopefully soon, we will have an in-person meeting in Seattle. But for now, it's all on Zoom, and this is all the kind of stuff we talk about. So, how to vet an operator, how to go through all the documents, all the paperwork. It's a really great atmosphere to learn about, because, nothing is truly passive. I know that contradicts everything we talked about, because you still have to actively find a syndicator that's worth their weight in gold. And, I highly encourage you to do a ton of due diligence, like you said, and really vet the operator. And that's the kind of stuff we talk about in our group.
Exactly. So, again, I spent myself 16 years working as at a national private real estate investment company as a senior asset manager and an investment partner. That's my background as well. So I fully understand the due diligence, the systematic and focused asset management, and the extremely high level of integrity required to perform as a high quality, syndicator. Me, myself, I have twin girls that are 12 years old. And when they were born, I transitioned out of that role, and I still needed a place to invest my money in larger projects and diversify my assets, because I'm not really interested myself in buying or managing one-off, single family investment properties. So, as a result, I've spent the last, 5 to 7 years vetting personally for myself, where can I invest my money, and with syndicators, knowing that, sure, I can play that game, but my lifestyle I've chosen is that's not for me. I prefer to be passive, right? And do what I love doing, which is brokerage and investment on the side as well. And so, just because somebody tells you that they're a syndicator and they've done big projects, they have a show or a podcast about investing, does that not mean you should invest with them. There's a extra level of due diligence that you are going to want to do. And I'm happy to introduce you to Spartan Investment Group and my friend Ryan Gibson and his team here today. And like I said, if part of the reason I wanted to do this podcast as I talked to Ryan is that a lot of my clients on the brokerage side, they have needs to place money once they sell their properties, right? Or maybe they are, tech employees that, want to get involved and get started in real estate investing, and diversify what they're doing. Some have more time than others, and just took this opportunity to make sure that I get to introduce you guys. And I thank you for your time today, Ryan. I think we're running short here, or running long like we always do. Ryan and I could talk for 15 hours and never get bored. But thank you. If anybody has any questions, feel free to reach out to me. Again, my name's Julie Clark with the Nuts and Bolts of Real Estate Investing podcast. I'm also a traditional real estate broker as well as a commercial broker with eXp Realty. And you can reach me at 206-910-2985. That's my cell, or text me. Or you can email me at Julie, Julie.Clark, C-L-A-R-K, at exprealty.com. I highly, highly encourage you to reach out to Ryan, engage in all the education in their platform. Like I said, Joe is going to be attaching the Spartan dash, like a what I call it, a hyphen, Spartan-investors.com is where you can look at Ryan's website, and they have a page on there full of webinars and all kinds of educational stuff on their Learn page that will attach down to the podcast here below. And what should somebody do? Ryan, first of all, what's the minimum investment?
Yeah, sure. So the minimum investment's typically $50,000.
Okay. And do you have investors? What's the maximum? Do you have a maximum? I mean, it depends on project by project, but do you have people investing hundreds of thousands of dollars with you?
Our biggest investor has placed $3.4 million into a deal, and our smallest investor obviously is the minimum. So when we just did and then the average investor I think is about $200,000 across all deals. But yeah, $50,000 is the minimum, and we just finished a raise of $4 million. So the maximum investment you could make in that deal would be $4 million, because that's how much we're raising, and then the minimum was on that one was $50K.
And how do you get access? Like, you get filled up, you have a raise. Is it first come, first serve?
It is, and we just send the deal out via email. So if you join our investor list, if you go to our website, you can click on Invest Now and fill out your information. That's how you get onto our list. And we'll also reach out to you when you fill that out to schedule a call. You don't have to do the call if you don't want to, but that's how you get on our list. We like to get to know our investors. So we do really like to hear from you and hear what, your objectives are. And then once you're on our list, you'll get an email with the offering. And then that's how you get alerted to our deals. And then, just email us your interest and stuff like that when deals come out. So
the first thing, if people want to learn more today, is to go to your website and, get educated there. And if they feel comfortable with that, then sign up to get on your email list and further discussions that with Ryan and his team. I think that is fantastic. Well, Ryan, always enjoy talking to you. Again, thanks for your time. And Joe, where can everybody find the details about today's podcast?
Yeah, so if you'd like to read about anything that we've talked about today, you can go to seattleinvestorsclub.com/127. That's seattleinvestorsclub.com/127. And if you really liked us, we'd love for you to review our podcast on whatever platform you are listening.
And as a reminder to everybody that is listening out there in podcast land, Joe and I host a weekly real estate meetup. It is every Thursday from 11:30 a.m. to 12:30 p.m. Pacific time. And it is basically just a weekly open discussion about all things real estate, current topics. We solve each other's problems. We collaborate. We share deals. Who attends this? all real estate investors, any type of real estate pro, whether you are flipping houses or doing new builds or BRRRRs, buy and holds, or commercial real estate. If you're a conventional lender, a private money lender, any type of, you have a niche business and related to real estate, you're a real estate broker. You bring your questions, your problems. We share resources. It's just a great place weekly to check in when you can. And how you access that is you go to our meetup.com page for Seattle Investors Club. And every Thursday morning, you can just grab the link to the Zoom access to join the conversation. And we hope to see you guys all in the future where you get to unmic yourself and talk just like Ryan and his team do. Open discussion about anything that comes up, and is a very worthy place to connect with your peers. So once again, thank you. And we'll catch you on the next one. Over and out.
Thanks, guys.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.